Hello guys, thank you very much for joining in. We will be starting in 2 minutes time. Okay guys, thank you very much for joining today. Today the agenda for our discussion is a financial product and we're going to be talking about swaps, and in that swaps primarily about interest rate swaps. Okay, so what is the agenda for today's discussion? First is what exactly is a swap. Okay, and that particularly interest rate swap, we'll be understanding how a floating rate is very important in your interest rate swap, and what is a floating rate that normally companies use in their contract. Then we'll also look into some of the example of a swap. We'll take two companies and we'll describe the entire swap process in the example. And then we'll also look into with the cash flow, the example continuation with that with the cash flow will also be explained to you in detail. And then if suppose there is a notional payment allowed, then how does that cash flow changes, and what is a swap from a different perspective. If you look at that product as a swap, and how do you differentiate it and look at it from a different perspective as a bond. So we'll look into that in detail. We'll also look into how actually companies use swap in real life. Okay, if they have a liability, then how do they use it, and if they have an asset, then how do they use it. And finally we'll have the queries available for us to discuss upon, and we'll open up the room for questions and queries also. Okay, now with this, let me start the first point. What exactly is a swap? So swap is primarily an OTC derivative contract. Okay, so in real life, in market, you'll find exchange and you'll find OTC. So swap is only dealt in OTC derivative, wherein there are two components of a cash flow that is going to happen in future time. Okay, when we are saying two component of a cash flow between two companies, basically two counterparties. So one component is generally fixed, another component is generally floating. There can be different examples also, but for today's presentation, we're going to look at a very simple plain vanilla example where it's going to be one component fixed and the other component as floating. Okay, so normally an interest rate swap is based on interest rate. Okay, and but there can be a swap available on an exchange rate also. There can be a swap available on volatility also, that means other market variable, or there can be a swap available on commodity rates also. But for today's example, we are going to be focusing on interest rate swap. So let us look at a simple example of a swap. For example, there is a counterparty A. Let us take that company as an Apple organization, Apple company, and there is a different company which is an investment bank, counterparty B, as Citigroup. Okay, suppose they enter into a swap example wherein Apple is paying a fixed cash flow to counterparty B, and counterparty B is paying a floating cash flow which is based on floating rate. Okay, we'll look into the floating rate in detail. So this is a generic structure that you will see for a plain vanilla interest rate swap. So there'll be a counterparty A, there'll be a counterparty B, and both the terms of the agreement, what Apple will do, what Citibank will be doing, will be decided before the agreement starts, before the interest rate swap starts. Okay, now let us look in detail what exactly is a floating rate that is being talked about. Okay, now floating rate generally that we use is a LIBOR rate. LIBOR is London Interbank Offer Rate. This rate is decided every day by British Bankers Association, and this rate is available for different maturity. That means the rate is available from today for the next 6 months, from today next 1 year, from today to next 9 months. So that way you will find the LIBOR rate being available for different maturity. Okay, so the floating rate generally that we see in the interest rate swap is a LIBOR. There can be different floating rates also. Okay, LIBOR is used as a reference for a lot of loans in international finance market. That means you will find bonds, which is floating rate bonds, based on LIBOR. Okay, we'll look at one example of floating rate bond. Suppose there is a 5-year bond, which is a floating rate bond, and in that the floating rate decided is LIBOR. And suppose that bond is telling its investor, okay, I will give you LIBOR plus 0.5% per annum. Okay, and normally what the bond generally pays is it pays on a semi-annual basis. So whatever the bond is supposed to pay on an annualized basis, they will pay on a 6 months basis. That means the life of the bond is actually 6 months for the entire 5-year period. Okay, now for each time frame, whatever is a 6 monthly LIBOR rate available, that LIBOR rate will become the base. Suppose for the first 6 months, the LIBOR rate was 7%. Now, as per the agreement, LIBOR plus 0.5. So the bond issuer will pay 7.5% to the bond investor. Okay, and that is the reason we'll find that LIBOR is mostly in an annualized format. We'll look into it. What does this mean when we are saying that the LIBOR is actually in an annualized format? Okay, so we'll have a quick example about swap. Okay, and we have given this example in a very simple manner so that you understand the basics about the product. Okay, now let us look at this example. Suppose in hypothetical 3-year swap is initiated. Okay, that is initiated on March 8, 2017 between two counterparties, Apple and Citigroup. Okay, and what they have decided is that every 6 months, I'm repeating, even though the contract is for 3 years, every 6 months the cash flow will be paid. Okay, now how exactly the cash flow will be paid? So as written, Apple is agreed to pay Citigroup a fixed amount of 3% per annum. See, you can see that 3% is mentioned as an annualized basis. Okay, even though we are going to make the payment on a quarterly basis, sorry, on a monthly, on a 6 monthly basis, the amount which is the rate which is mentioned over here, that is 3% per annum, is actually mentioned in an annualized format. Okay, on a notional principal of $100 million. This principle is a notional principle. That means this principle is not exchanged anytime during the contract. This principle is only used to calculate the amount. Okay, so Apple is agreeing to pay 3% on the notional principal of $100 million. Similarly, Citigroup has agreed to pay a 6 months LIBOR rate on the same notional amount. That means $100 million. Now, how does this swap actually looks like? If you look at the diagram, there's first counterparty, that is Apple. There's second counterparty, that is Citigroup. Okay, now Apple is going to pay 3% per annum. Okay, but this payment is going to be done on a 6 monthly basis. Similarly, Citigroup is going to pay a 6-month LIBOR rate. Okay, the rate is mentioned annualized. We have to bring it on a 6 monthly basis. Okay, this is the normal structure that most of the interest rate swaps follow. Okay, in this case, the counterparty A, which is basically your Apple, is a fixed rate pair. That we can see at the bottom is actually a fixed rate pair, and Citigroup is actually a floating rate pair in this entire transaction. So you will find a lot of the time that you will see that my organization has entered into a swap as a fixed rate pair. So what does that mean? That means in this swap you're actually making the fixed percentage payment every set time. Okay, now we'll take this example of a swap and we will take this to the next level. That means we'll go in detail about the questions. Okay, so we'll start with the first example from that perspective. The first part or the example is counterparty A, counterparty B. Counterparty A is paying 3% per annum. Counterparty B is paying 6 monthly floating rate, which is a LIBOR rate. Okay. Now, if we look into this entire transaction, and the contract is starting on 8th of March 2017, and the contract is for 3 months. Please remember this date was 8th of March 2017, and this contract is there available for a notional principal of $100 million. This has been decided on the start date. So the start date of the contract is 8th of March 2017. Now we'll look at the timeline of the entire transaction. On the first date, when the contract agreement starts, suppose the LIBOR rate is 2.2%. Please let me tell you that this 2.2% is nothing but an annualized rate. We'll have to get it on a semi-annual basis. Okay, so the first day, which is 8th March 2017, there is no exchange of cash flow. Okay, but on that day, we know that that 6 months LIBOR rate is actually 2.2% on an annualized basis. Now, if we move ahead in time, we go to the next date, which is the 6 months lead date, which is 8th September 2017. What happens on that day is they're going to do $100 million into 0.5. Why 0.5? Because the rate that is mentioned of 2.2% is an annualized. We have to get it on a semi-annual basis. That means the amount comes to 1.1 million. That means $100 million into 0.5 into 2.2 percentage. That is $1.1 million. That is the amount that Citigroup, which is paying floating, has to pay to the Apple. Okay. Now look, let us look at the fixed cash flow. In this case, the fixed cash flow is $100 million, 0.5 into 3%. That means $1.5 million that has to be paid from Apple to Citigroup. Okay. Now, if you look at this entire transaction, what is happening is Apple is paying $1.5 million and receiving $1.1 million. That means on a net basis, Apple has to pay only $0.4 million. Okay. And on this date, as we make the payment, so we are making payment basis the last LIBOR rate that was 6 months back. Okay. But today we know that the LIBOR rate for the next 6 months is 2.8%. We can see that this is also on an annualized basis. So what will happen? We go to the next 6 months date. That means 8th March 2018. And what will happen is we will use the previous 6 monthly LIBOR rate, that is 2.8%, and we'll do the entire calculation again. That means Citigroup is going to pay $100 million into 0.5 into 2.8. That means $1.4 million. Similarly, the Apple Group will pay $100 million into 0.5 and into 3% is equal to $1.5 million. Okay, so that entire thing will happen, and you can see from this cash flow itself that Apple is going to pay $1.5 million, but it is going to receive $1.4 million. That means net payment of around $0.1 million will happen from Apple to Citigroup. Okay, so this will keep on continuing till the time we complete the 3-year period, because that is a swap period. Okay, now let us take the same example and let me do the entire calculation in a table for you. Okay, now what happens is the first exchange happens on 8th September 2017. Please remember that the swap was started on 8th March, and the next 6 months, that the immediate 6 months that came was 8th September 2017. And that is where the first exchange happens. And what is the exchange? We saw that it is going to be $1.4 million, $0.4 million from Apple to Citigroup. We did the entire calculation. Okay. And this is what is mentioned. And the last line which is highlighted, please look at that line very carefully. This basically tells you that the notional principal is $100 million. That means that principal is not exchanged. We'll look into the next slide why there is no difference even if we exchange that principal. But for the timing, we know that this principal is not going to get exchanged. Now, how exactly this entire swap looks for the entire 3-year time frame? Okay, so swap starts on 8th of March 2017. On that day, the LIBOR rate was 2.2%. This 2.2% will be used in future. That means to calculate this $1.11 million, we'll use 2.2%. Okay, so whatever the rate that we see on 8th March 2017 is actually going to used on 8th September 2017 for making the payment. So we saw this first calculation, which is giving Apple has to pay negative. That means since he's paying, that is why it is negative $0.4 million. Similarly, on the second day, which is 8th March 2018, Apple will pay only $0.1 million. $0.1 million. And as we move ahead in time, the rates are increasing. The floating rates, the LIBOR rates are increasing. And you can say that Apple starts receiving money in the swap. So initially it was paying an X amount and then he started receiving the amount. This is happening because the rates are increasing. And if you look at the Apple cash flow, Apple is actually paying fixed and receiving floating. That means whenever the floating rates increase, Apple is in a beneficial position. That is why, since the rate of interest is increasing, Apple is actually making a lot of money as we progress into the swap. Okay. If I take the entire same example and if I add the cash flow also in this transaction, that the cash flow of $100 million, how does this entire transaction looks into? Okay. If we add the principal that is exchanged at the end of the diagram, that means $100 million. So what will happen is Apple will transfer $100 million to Citi and Citi will also transfer $100 million. You can see that at the end we have added $100 million to the entire table. But what happens is, since Apple is actually making a $100 million payment and Citi is also making the same amount, there is no impact of that $100 million on the entire swap transaction. You will find that the entire payment is only $0.45 million that Apple is going to receive from Citigroup. Okay, this is how the cash flow of a swap works. Now we are actually entering into a domain where you will understand how a company actually uses swap and how do we see a swap from a very different perspective. Okay, the next part is basically swap. We are looking from a very different perspective. We are taking the same example, Apple, Citigroup. Apple is going to pay 3% per annum to Citigroup, and Citigroup is going to make 6% monthly LIBOR rate. That is floating rate is what Citigroup is going to pay to Apple. Okay, we're going to take the same example, but we're going to look at this example from a bond perspective. Now, why we look at bond perspective? Because when valuing a swap, we will use a valuation methodology based on bonds. Okay, now coming to the bond example, now whenever you issue a bond in the market, you become a bond issuer. Okay, and somebody who purchases a bond from you becomes a long position. That means a bond investor from you. Okay, so if suppose you are a bond issuer, you basically become a short position holder in the bond because you receive the entire principal amount at the start. That means you are in a short position. And suppose there is an investor who is actually purchased the bond, that person becomes a long position holder in the bond. Okay, so short position holder, what he is going to do exactly is, at the start of the contract, this person is going to take, the bond issuer is going to take the entire principal amount from the investor, and as per the decision made in the bond, that means 6 monthly or annually, the bond issuer is going to make the coupon payment or interest payment to the investors. Okay, so principal payment is done by the bond holders to bond issuer, and bond issuer is going to make semi-annual interest payments to the bond holder. This is a normal bond structure. Now, why did we look at this example? Because we want to see, is it possible to look swap as a bond example? We'll look into it. Suppose we take an example of Apple. So just look at Apple and see that Apple is actually making a fixed cash flow every 6 months to Citigroup. That means if you look at Apple, Apple is actually had taken a short position in a fixed rated bond. If you look at this entire leg, of 3% per annum. If you look at only that leg, you will realize that Apple is making every 6 monthly payment of 3% per annum के हिसाब से, and that means it is actually taking a short position, because in the example we saw that short position bond issuer is actually making a payment to the bond investor. Okay. Similarly, if we look Apple from a different leg, that means 6 monthly LIBOR rate leg, you will realize that Apple is receiving a lot of cash flow every 6 monthly from the Citibank group. Now, if you look at this position from Apple's perspective, this is actually a long position on a floating rate bond, because every 6 monthly Apple is going to receive a coupon of floating rate. That means he has purchased that floating rated bond, and every 6 months he's going to pay a fixed rate. That means he is a bond issuer, he has taken a short position in that bond. So this is the payoff or entire description of a swap from the bond perspective. Okay, if I look at this entire example, again and look it from the Citigroup perspective, how does it looks like? Okay, we realize that Citigroup is going to receive a fixed payment. That means it is actually a long position. That means he is a bond issuer in a fixed rated bond. Similarly, Citigroup is also paying a floating rate. That means Citigroup is taking a short position in a floating rated bond. Now let me connect both the examples together. We can connect these two parts. That means when we look at the first leg, that is 3% per annum, Apple is actually paying it to Citigroup. That means Apple is a short position in a 3% per annum fixed rated bond, and Citigroup is a long position in a 3% annum bond side, that leg side. Okay. If I look at the second part, that means the floating rate part, I will realize that Apple is receiving floating rate from Citigroup. That means Apple has taken a long position in a floating rate bond, and Citigroup has taken a short position on a floating rate bond. So this slide is going to emphasize you how a swap can be looked as a bond, and this is a very important concept when you actually go and value an interest rate swap in your job or in your exam. Okay, so let's move on to how exactly a swap is used in a real life by a company. Okay, suppose if a company has a liability, that means a company has already taken a loan, and how they are using a swap to transform it, to convert into a different liability. Let's look at the example. Suppose Apple has taken a loan from outside. Okay, it has already entered into a contract with a bank wherein he has agreed to pay a LIBOR plus 0.1%. Similarly, Citibank has also taken an outside loan with some other bank wherein he is liable to pay 3.2% per annum outside. Okay, now Apple and Citigroup, if they come together, they can convert this liability into a different liability. Now how does that look? Suppose Apple has already taken, I'm coming back to the same example. Apple has already taken a loan of a LIBOR 0.1%. Okay, but now Apple realizes that interest rate is going to increase. But if the interest rate increases, Apple will be in trouble because he has already taken a loan which is a floating rate loan. And if the interest rate increases, Apple will have to pay more cash flow. Okay, so now Apple wants to convert this loan into a fixed rated loan, but it cannot do so because it is already a contract that he has entered. Okay, similarly, Citigroup has already entered into a fixed rate loan of 3.2%. Now suddenly if Citigroup realizes that interest rate is going to go down, okay, now if the interest rate go down and if Citigroup is continues paying 3.2% per annum basis, that will be a loss to Citigroup because the market rate has gone down. So ideally they should benefit from the reduced rate, but they cannot do anything because that contract of a fixed rated loan is already established and they cannot change it. So what they do is that Citigroup feels, Apple feels that the interest rate is going to increase, and Citigroup feel that the interest rate is going to go down. So they will not change their outside loan agreement, and they will enter into an interest rate swap to convert that loan into a different loan. That means Apple will convert the LIBOR rated floating rate loan into a fixed rate loan using swap. Similarly, Citigroup is going to convert a fixed rated loan into a floating rated loan using a swap. Let's look at this, how exactly they are going to do. So we have Apple, which has an LIBOR rated floating rated loan already established. And since the arrow is moving out, that means Apple is actually playing that floating rate outside. Okay. The second counterparty, that is Citigroup, it has already entered into a fixed rated payment or liability outside. So the arrow going out actually signifies cash flow going out. Okay. Now, if they enter into a swap wherein Apple agrees to pay 3% per annum, the same previous example, and floating Citigroup agrees to pay a 6-monthly floating rated LIBOR, how this entire transaction is now converting their liability. We'll look into it. First, let us look at Apple and how it is impacting the loan. So Apple is paying, so we'll bifurcate the 3 transactions of Apple, the 2 transactions into the swap and 1 transaction outside the swap. We'll bifurcate all of the 3 and we'll see how it is actually changing. Okay, so first transaction is LIBOR. Apple is paying LIBOR plus 0.1% to its outside lender. Okay, second point is that Apple is receiving 6-monthly LIBOR rate from Citigroup, that is within the swap. And the third is that Apple is actually making 3% per annum payment to Citigroup within the swap, this payment. Okay, if I combine and look at all the 3 parts, can you realize that Apple is actually paying LIBOR plus 0.1%, but it is also receiving LIBOR. That means LIBOR is actually cancelling out, and Apple is actually paying 0.1%. Okay, plus it is paying 3%. That if we combine these two, Apple is paying in entirety 3.1% fixed. Okay, now what is the benefit of the swap now? Initially, Apple was paying floating rate. As it get into a swap, it has converted that floating rate into a fixed rate payment of 3.1%. Fixed rate payment of 3.1%. Okay, now let us look at Citigroup and see how it is impacting Citigroup. Okay, so if I look at Citigroup, Citigroup also has 3 payments. The first payment is Citigroup is paying 3.2% out to its outside lender. Second payment is that Citigroup is paying 6-monthly LIBOR, this rate, to Apple. And third payment is Citigroup is actually using 3% per annum, receiving 3% per annum from Apple. If I combine all of the 3, can you realize that if I look at the first and the third point, this is actually 3%. There's an incorrect number. Okay, now if I look at the first and the third point, do you realize that Citigroup is paying 3.2% outside and receiving 3%? That means on a net basis, it is actually paying only 0.2% per annum. And simultaneously, it is paying LIBOR. So that means the final payment combining all the 3 conditions is actually LIBOR plus 0.2%. This is the amount. So what we have done is we have transformed our floating rated liability or loan into a fixed rated liability by entering into a swap. And similarly, a Citigroup has converted its fixed rated liability into a floating rated liability by entering into a swap. This is how a company uses. So for example, if I am Mahindra and I have already taken a fixed rated loan of 10 years and I cannot change that transaction, but I realize that fixed interest rate in market is going down and I want to change that, but I cannot change it. So what I'll do is I'll enter into one more transaction, that is an interest rate swap, and the entirety using the swap and the original loan, I'll convert my fixed rated loan into a floating rated loan. Similarly, I'll be able to convert my floating rated loan into a fixed rated loan. This was from the perspective of liability. But if we look at asset, that means if suppose a company has already invested in an asset, that means the company is going to receive a cash flow. Okay. Now let us look at this example and see how swap is actually able to help you in this entire process. Okay. Suppose Apple has already invested in an asset which gives him 2.7% per annum. Okay. This is a fixed investment. Similarly, Citigroup has already invested in an asset which gives LIBOR minus 0.2%. Okay. So whatever may be the LIBOR rate, if the LIBOR rate is 5%, then Citigroup is going to receive LIBOR minus 0.2%. That means 4.8%. If the LIBOR rate is 10%, then Citigroup will receive 9.8%. Okay. Now, do you realize in this example, Apple is receiving fixed rated, Citigroup is receiving floating rated. But if suppose Apple feels that interest rate is going to get increased, Apple cannot change the original transaction of investment of 2.7%, but he can enter into a swap to convert this fixed rated asset into a floating rated asset. Similarly, a company which is Citigroup, which has already entered into a floating rated asset, cannot change that asset. So what he will do, he will enter into an interest rate swap to convert that swap from floating rated to a fixed rate. Let us look at that example. Okay. We have Apple, which is going to receive. So you can see arrow coming inward. That means Apple is going to receive 2.7%. And similarly, Citigroup is going to receive LIBOR minus 0.2%. Okay. Suppose they decide to enter into a swap, the same example of swap. Now, how does this actually going to change the entire thing? If you look at Apple, Apple is going to receive 2.7% per annum from the outside asset. It is actually going to receive the 6 monthly LIBOR rate, and it is actually going to pay 3% per annum in that swap. If we combine all of this, okay, so you will realize that the first and the third part will negate itself. That means Apple is going to receive 2.7% and it's going to pay 3%. That means on a net basis, Apple is going to pay 0.3%. And also, okay, sorry, if you combine the first and the second point, my bad, if you combine the first and the second point, Apple is going to receive 2.7% and it is also going to receive LIBOR. That means actually the Apple is going to net off the first 2.7% and the last 3%, and on a combined basis, it is only paying 0.3% plus LIBOR. So Apple is going to receive LIBOR and it is paying 0.3%. That effectively means that Apple is going to receive LIBOR minus 0.3%. Now what they have done is they have converted their fixed rated asset into a floating rated asset by combining the original asset into an asset and doing the transaction. If I look at Citigroup, okay, Citigroup also has three positions. The first position is that it is going to receive LIBOR minus 0.2%. That means 20 basis point, that is 0.2%. It is also going to pay so it is also going to pay 6 monthly LIBOR rates to Apple, plus it is also going to receive 3%. Okay, if suppose I combine these two, the first and the second point, do you realize that Citigroup is actually going to receive LIBOR minus 0%, but it is paying LIBOR. So on a net basis, it is actually only paying 0.2%. And if I combine it, it's going to have an impact of 2.77%. Basically, it's basically 2.8%. There is a typo over here. That is 2.8% on a net basis. That is what the Citigroup is going to convert. Now, what Citigroup did, it actually converted its floating rate asset into a fixed rated asset. Now, if I look at the entire transaction again and summarize it, what is happening is that Apple has already taken asset which is a fixed rated asset. It feels that interest rate is going to increase, and if the interest rate increase, will not be able to make money. So we enter into a swap to convert a fixed rated asset into a floating rated asset. Similarly, Citigroup has entered into a floating rated asset, and they feel, okay, the rates are going to come down, and if the rate come down, we'll lose a lot of money. So we should actually convert it into a fixed rated asset. So we will combine that original floating rated asset with the swap, and we'll convert it into a floating rated asset, sorry, fixed rated asset, that is 2.8%. This was the entire transaction therein actually company uses to convert its assets into from floating to fixed to fixed to floating. Now let me give you a simple example. If I am ITC and I have $100 million invested into a bond, a corporate bond, which gives me fixed rated. But if I feel that when I entered into the contract, at that point in time, the interest rate was 7%, but now the interest rate has gone to 15%. But that bond is only going to pay me 7%. Now, I want to earn more money, but I cannot change that bond transaction. I want to keep that bond transaction. I will enter into a swap to convert that fixed rated 7% income to a floating rated 7% because I feel that the interest rate is going to increase. This is how exactly a swap is used to convert, okay, your liability or a asset. Okay, now this is how we will this is a snapshot of how we teach a product, a financial product, to our students.